Welcome to part 6 of the Small Business Finance series. For the next few videos, we'll be looking at financial forecasting. In this introductory episode, I'll describe the different elements of a financial forecast and have a quick look at what they tell us. When looking at a financial document, one of the first things you need to ascertain is whether it's reporting what actually has happened in the past or predicting what might happen in the future. This might sound a bit obvious, but the reason I bring it up is that the three elements of the financial forecast I'll be introducing have almost identical equivalents in financial reporting. Whilst reports are expected to be very accurate indeed, forecasting necessarily involves a bit of estimating. The estimates should be based on historical data, information about competitors, quotes from suppliers, etc., and needs to include the following: the likely level of fixed costs for the forecast period, things like staff wages and depreciation on equipment, variable costs like raw materials and ingredients, the likely level of capital expenditure on things like machinery and equipment, and here's one that I haven't covered in a previous video, a sales forecast. This is a topic that many proprietors of startup businesses are very suspicious of, so I'll dedicate a future video solely to sales forecasting. Once we have all that information, we can perform some calculations and produce the three elements of a financial forecast. It's not always necessary to produce all three projections. Here they're displayed with the most commonly used at the top and the least common at the bottom. The three projections all serve different purposes. The cash flow forecast predicts how much money a business will have throughout the forecast period. If a business runs out of money, perhaps because customers are slow paying or it can't get the loan funding it needs to replace equipment, then it will fail even if sales levels are healthy. Therefore, the cash flow forecast answers the following question: will it be possible to run the business during the forecast period? Now, it might be possible to continue running a struggling business for some time, either by selling its assets or by taking out a loan. But a loan isn't profit, it needs to be paid back eventually. So the profit loss account answers a different question: will it be worth running the business during the forecast period? The projected balance sheet, unlike the previous two forecasts, which covered the whole of the forecast period, describes just one moment in time. And in this case, the projected balance sheet answers the question: what state will the business be in financially at the end of the forecast period? I'll be dedicating a separate video to each of these financial forecast elements. First though, the next few videos will briefly describe some key concepts that will help you get the most out of financial forecasting. Don't forget to subscribe to the YouTube channel. It doesn't cost anything and you'll be kept informed whenever a new video is released.